Good afternoon, everyone, and welcome to Unlock the Stock with Attacq and Tharisa. It's our pleasure to welcome both companies back to Unlock the Stock, a platform that is specifically designed for retail investors to gain access to corporate management and to get to know them and their companies better. This event is sponsored by A2X, a stock exchange playing an integral part in the progression of South Africa's financial markets. A2X is the second largest stock exchange in Africa now, as measured by market cap, with 137 securities listed, including 27 top 40 stocks with a combined market cap of over 9.2 trillion. There is no cost, risk, or additional regulation for a secondary listing on A2X, and it provides an issuer's investors with the opportunity to save money. The team at A2X are proud to be partnering with Unlock the Stock, just as Unlock the Stock unlocks value through insights and key analysis. So A2X unlocks values for the stocks listed on its platform, helping to drive the market forward. Unlock the Stock would not be possible without our technology partner, Lumi Global, and their website is lumiglobal.com. Please visit to find out more about their various integrated online AGM and investor presentation solutions. Our hosts, as always, will be the finance ghost and Mark Tobin from Coffee Microcaps, and they will be facilitating the Q&A sessions. Today, we'd really like to welcome Attacq, represented by the CFO, Raj Nana, and Michael Campett, the Property and Asset Management Executive, and Tharisa, presented by Ilya Gralich, the Head of Investor Relations and Communications, as well as the Michelle Taylor. And before we start, just a few housekeeping rules to go through. Each company will do a presentation of about 12 minutes each. Then you'll see a button at the bottom of your screen to select which breakout room you'd like to join to post questions to management, and each Q&A session will last about 20 minutes. You're more than welcome to leave the one room and go to the other, and please note you will only be allowed to post questions by typing them into the chat function at the bottom of your screen. The event is being recorded and will be available on the Unlock the Stock YouTube channel later. Once in the breakout room, you will see an email address you'd like to be added to that particular company's distribution list. I'll now hand you over to Tharisa, so please can you share your screen, Michelle?
Thanks, Debs. I think Ilya will share the screen shortly.
Apologies, thanks.
So thank you, everybody. Thanks, Debs, for the introduction. My name is Michelle Taylor. I'm the Chief Operation Officer of Tharisa. Tharisa PLC is a company listed on both the Johannesburg Stock Exchange and the London Stock Exchange. And so the question is, why Tharisa? Why are we even talking about us today? Well, we have long life assets in our portfolio. Ilya, if you'll just move on to the first slide. Next one. In terms of our assets, we have significant shallow mining resources. And it's really important that we talk about this for a couple of minutes. The first is that we have a significant asset in South Africa. It's some 849 million tons. That's a Tharisa Minerals mine that has an 18-year open pit life of mine, with potential of 40 years underground. Similarly, in Zimbabwe, we have another asset, and that's the Karo Platinum asset. This mining right extends over some 24,000 hectares. And of the 24,000 hectares, we've actually explored less than 10%. But as a result of the exploration that we've done, we've actually been able to get certainty around the resource that we have, and that's at 152 million tons, which again gives us an open pit 17-year open pit life of mine. It's a significant phase for our phase one in terms of Karo Platinum. At Tharisa, we've always adopted a pit to port strategy. Many would say, why on earth don't you simply sell your products at the mine gate? And the reason we do it, we actually have a pit to port strategy is so that we can capture value right across the value chain. So we mine, we process, we trade our commodities, and we move it to our customers. And from a chrome concentrate point of view, most of our customers are sitting in China. In terms of PGMs, we have PGM offtake agreements in South Africa. So managing the movement of our product in terms of South African rail and road infrastructure. We can talk a little bit more about that in a little while. In terms of product diversity, I've said to you, we produce both PGMs and chrome concentrate, and that's really important in terms of the optimization of our business and the profitability. Moving on to the next slide. When we look at this, it's clear from our point of view, we're profitable. Certainly, we've been profitable since 2015. We have a co-product commodity strategy, and that delivers into the demand of both products. From an investment point of view, we've invested some $530 million into our operations over the last 10 years, and we've ensured optimum resource extraction through innovative processes. We've returned some $90 million in cash to our shareholders, and we've repaid $202 million in terms of corporate debt. Vision 2025 is around the corner for us, because when we started working on this was probably 5 years ago, and now it's creeping up really quickly. So moving on to the next slide, why is Vision 2025 important to us? This is about enriching lives through innovating the resources company of the future. So at Tharisa, expansion is key, but expansion and rolling out our business sustainably is even more key. Optimization of our existing operations, that's a key focal area for each of our business units and for each of our management teams. Innovation is key to our success, and we believe that innovation is key to sustainable success in the longer term. From a diversification point of view, we've diversified in terms of our products. We obviously have both PGMs and chrome that we produce in South Africa, but adding the layer of Karo Platinum in Zimbabwe adds another sense of diversification because we're now geographically diversified. In terms of our investment, we hope to be the investment of your choice in our sector. Enrichment. Well, we've said that we want to enrich the lives through the innovation of the resources that we mine. So moving on to the next slide, I think from a positive impact point of view, we've created some 4,600 jobs in South Africa. That's both on a direct basis and a contractual basis at the Marikana mine. In Zimbabwe, we're currently at 440 employees. From a gender diversification point of view, we're at 25% in terms of female employees. And I think the statistic that I'm most proud of is probably that we haven't lost any days to industrial action. In a volatile area within which we work, I'm pleased to say that we've had good relationships both with our employees, firstly, and secondly, with the unions operating at our mines. And that's given rise to the fact that we've been fortunate in not having industrial actions. In terms of education and wellness, I think for each and every one of us on this call, education and wellness is key to each of us as individuals, as mothers or fathers and of families. This is a key component of our lives. So to that end, we focus on adult education programs on site for both employees and the people living in our communities. And when we talk about our communities, we've got some 2,500 households in the near vicinity of Tharisa. So those are the households we hope to impact. Of course, school and basic education is key, and on that basis, we work closely with the local schools in terms of stationary drives, information technology centers, developing those, donating into those, maintaining those schools, and just working collaboratively with the local schools. In terms of environment, we're planning a 30% reduction in terms of carbon footprint by 2030. And of course, the goal is carbon net neutral by 2050. Now, it doesn't help to just make those statements. One's got to actually say, well, what are you doing? And I think to that end, what we're pleased with is so far, we've had environmental authorization awarded for a 40 megawatt solar plant. And we're in the first phase of being initiated in Zimbabwe around a 30 megawatt solar plant. So moving back to our commodities, again, why Tharisa? Well, Tharisa produces both PGMs and chrome concentrate. And I think you've got to stop for a moment and just think about, well, what do PGMs do and what does chrome do? So PGMs is that unique metal that we need in terms of the industrial combustion engine. And it's also unique in terms of what's needed in terms of hydrogen economy. Where that goes is from a supply point of view and the outlook in PGMs. And PGMs is something that's probably familiar to most of you on this call. I think the message has been continuous from every analyst that you speak to. Primary supply has growth constraints. What that means is that there is a record deficit in terms of platinum, there are deficits in terms of rhodium and palladium, and it's expected that those will remain into the near future. Those deficits will be driven by the demand drivers from Tier 4 and Euro 7 emission standards, which are still to come. In South Africa, we've seen supply falling off, and that's as a consequence of a number of things. Firstly, mines are getting deeper, costs are getting higher. We've had electricity and power constraints. And as a consequence of that, the shortfall in South Africa is expected to be replaced with supply coming online in Zimbabwe. Now, that's obviously not only supply from Karo and the project we'll talk about in a little while, that's across Zimbabwe supply coming through. Chrome is something people don't understand. Chrome is that element that makes stainless steel stainless. So when you look at your knife and fork tonight, remember that's stainless steel, and without that, that could be a rusty knife and fork. That's what you get when you add chrome to it. That noisy exhaust coming from a Harley Davidson, that's stainless steel. Stainless steel, we use it every aspect of our lives in terms of construction and building, and I could go on and on about it, but I just really want to emphasize to you why chrome is so important. The next fact that's important is that South Africa supplies 80% of China's requirement in terms of chrome. And of the 80% going into China, or of the South African supply going into China, 10% of that comes from Tharisa. That number hovers between 10 and 12%, depending on the supply fundamentals. So we're in a good position from a chrome point of view. We're producing some 1.6 million tons of chrome per year. All of that moves into China. And we're at a place where we've got record prices. And we've had record prices over the last 6 months in a commodity that can move quite substantially. And again, one doesn't understand it unless it's profitable and making money for everybody. We've got record rand pricing at some $6,000 Rand per ton. In terms of dollar terms, we're at $295 per ton. I think important here, and the last thing I'm going to say here, is both our PGMs and our chrome concentrate are sold in US dollars. And of course, the majority of our costs in South Africa are rand contained. So moving on to the next slide, I just want to, I suppose, just go back a step again and talk about innovation before we talk about PGMs again in our expansion program. Tharisa has been very focused in terms of innovation. You know, I think we all recognize that unless we innovate in our business, we won't be sustainable into the future. You've got to do things differently. We can't expect to do what we're doing today the same way in 5 or 10 years' time. So we've invested a lot of money in terms of research and development and working on our beneficiation sites. So at Arco Metals, we have a demonstration scale size testing unit in terms of PGM smelting. That's very innovative in terms of where we're going with PGM smelting into the future, particularly when you consider that PGM smelting is such a big proponent of power and how it draws power. So a lot of work being done there. We're focusing on downstream beneficiation, both on PGMs and on chrome. There's some alternative processing happening on a pilot scale on those projects. And then, of course, energy that I spoke to earlier. There's a facility focusing on energy storage solutions. And I think in the coming months, we're going to be telling you more about those projects and what they can mean to unlocking energy in our, I suppose, intense energy focused businesses. And if you move on to the next slide, Karo, and we want to spend a little bit of time on Karo. The reason being that most of you would be familiar with the Tharisa Minerals mine. That's been going for more than 10 years, and as I said, profitable since 2014. But Karo is a new project for us. It's part of our expansion profile. It's part of diversifying from a geographic point of view, and of course, increasing our commodity reach from a PGM point of view. So Karo is a tier 1 asset. It's got a first phase open pit of some 17 years. We will, and we are planning to produce some 190,000 ounces of PGMs. It has a significant base metal component to that. That means that our PGM production will double. So in South Africa, we circa 180,000 ounces, moving up towards a 200,000 ounce number. We'll double that as we bring Zimbabwe online. We expect to put first ore in mill in July of 2024. We've started our earthworks, which are completed substantially in Zimbabwe. We're doing some trial open pit mining, and we expect first concrete to be thrown in June of 2023. So that's right now. In fact, the reason Phoebos isn't on this call is because he's actually in Zimbabwe looking at what the guys have done and what we're doing rolling out there. From an impact point of view, I think, again, pleased to say 4 years LTI free. We are compliant in terms of the environmental codes in Zimbabwe. And I think I said to you earlier, we've employed some 440 people, both as direct employees and contractors, and we expect that number to grow, and it will grow significantly. From a capital cost point of view, to total cost of the first ore in mill, the budget is $391 million. And on that, we've got multiple funding streams. We've got a Victoria Falls exchange bond that we've listed, and we've raised some $36.8 million. That was done at the back end of last year. As well as we're looking at some partial leverage of existing assets to the tune of some $130 million. And then there's a syndicated senior project finance facility of $260 million. So again, funding is in line. The project is in line, development happening at a really quick rate. And I've said an awful lot in a very short period of time, but I'm very aware that my colleagues from Attacq will be talking to you as well. So we'll have opportunity in the Q&A session to I suppose, dive a little bit deeper into the Tharisa business. So looking forward to chatting to you there. Thanks, Deb.
Thanks, Michelle. That was really interesting. I liked your Harley Davidson comparison there. I think that made everything easier to understand. Attacq, over to you. So Raj, if you could share your screen, the presentation. Thanks very much.
Great, thanks, Deborah. Thanks for the introduction. For those that are confused, I'm Raj, and Mike is sitting towards my right here. Hopefully, Attacq is a name that most of the participants are familiar with. Actually, this year marks our 10-year listing anniversary on the JSE, and perhaps some of our brands, some of our assets are perhaps more well known than the Attacq brand. Those like Mall of Africa, Garden Mall, Waterfall City, etc., and some of that we'll unpack in the next couple of slides. If you look at that, we've just put together a very short agenda covering a couple of, I think, main points that we'd like to convey to the participants dialing in today. Strategy, introducing our management team, our focus areas, talking a little bit about Waterfall City, quite a unique development within the South African context, a bit of insight into our capital structure, specifically around our interest-bearing borrowings, and then talking about our ESG initiatives, and then leaving some time for some Q&A. If we look at our strategy and our purpose and our vision, our purpose is to create smart, safe, sustainable community spaces, providing remarkable experiences. And our vision is to create sustainable value for all of our stakeholders through a value-based strategy, ensuring a positive impact in our communities and the environment we operate in. And we use both our purpose and our vision as our sort of North Star to guide us in making decisions, in driving our strategy, and implementing our strategy. If you look at the strategy itself, 4 main pillars. We like to think differently about real estate relative to our peers. We're a precinct-focused property owning company. And what do we mean by that? So we have a relatively small number of assets, less than sort of 50 assets. But we focus on precincts, meaning that these are not random assets spread around the country. These are specific assets that we look to control and manage to really drive the experience for the user. And if you look at the second pillar, it's really just the precincts on steroids. Developing a sustainable city, building the city through partnerships, and I think Waterfall City are quite well known in the market. We've been busy with that for longer than 10 years. And really, we're building something very special here, a safe, sustainable city. And we've done that over the last while with very valuable partnerships in the residential, commercial, retail sectors, really partnering with partners that are really experts within their own areas. And we've utilized that to a great extent. We focused on our capital structure quite a bit. During COVID, and the impact of the pandemic, we quickly de-geared our balance sheet. I think we managed to weather this storm quite well, and it's really because we constantly focus on optimizing our capital structure, trying to get it to really work for us in the best way possible. And we've recently announced a transaction with the GEPF, where they'll be acquiring a significant stake, 30% of Waterfall City, and that has a major impact on our capital structure going forward. And a little bit more about that later. And then we use ESG and diversification alongside our business, and we integrate that. And that really talks to how we look at things. We're not a company that ticks boxes in terms of ESG. It's really be aligned through our purpose and what we stand for. And I think we do that quite effectively. I'm going to tag team with Mike here, and we're going to briefly chat about how we're delivering on our strategy.
So just a quick update on our operational performance. The first set of numbers are up to the end of April of this year. So occupancy rate, that's the occupancy of our buildings, at 93.2%. At the second last bullet point, you will notice there we talk about the upgrade of Waterfall Circle. So the 24,000 square meter vacancy of Waterfall Circle is still in that number of 93.2. So once we get either a part or the full building let, we expect the occupancy number to jump significantly. Our collection rate at 104.3% so far for the year. That includes a little bit of a recovery we've made on Cell C earlier in this financial period when the recapitalization was announced and some payments were due. And then our client retention rate at 81.8%. That's about 189 leases that we've managed to renew so far this year. And certainly a lot of questions I expect later on today about are we seeing reversions when we do all these renewals and client retentions. On the positive side, I want to highlight that so far for the 12 months ended April, trading densities in our retail portfolio increased by 13.3%. A lot of that driven by Mall of Africa, but also some good growth out of our regional assets. Certainly, I do feel that retail would be facing some headwinds. We have seen sort of spend on unisex fashion taper off over the last 2 months, but certainly for the 12 months average, we've had a good run in our retail assets. Just stopping on the 15% turnover rental growth, a reminder to everyone that our retail assets have had generators since the end of 2019 or 2018 actually, and so we were well positioned to weather this continuous load shedding that we face today, and we kind of see this unanticipated benefit of our malls always being open, tenants always being able to trade, and we've had a significant increase in the turnover rental that we've built so far this year using the prior year as a base. And the reason for that was that our tenants were able to trade. So some sort of a subsidy for all of the diesel costs that we have to expense this year.
Thanks, Mike. Turning to our developments, this year we've completed the Plumnik head office and distribution center of about circa 15,000 square meters, a really world-class head office and distribution center, and something that's quite typical of what we've done here in our logistics precinct, combining distribution centers and warehouses with a significant head office component. The benefit to our clients is that it's all consolidated under one roof, which is a lot of synergies with both sort of your blue collar and white collar staff members working together, obviously saving on a lot of amenities that you can put under one roof instead of putting into two separate premises. Ellipse Waterfall Phase 2 completed. Just over 15,000 square meters of Phase 2. That's the third tower that was completed. With the completion of that tower, we launched the Luna Club, which includes an olives and plates, and a life day spa that will be opening up quite soon. The Ellipse sales continue to surpass our expectations. Phase 1 and 2, 95.4% sold. The majority of those units already being transferred to end users. Phase 3, which we launched from a pre-sales perspective in November, reaching a 56.5% pre-sale level currently, and we're looking to go into the ground in the next couple of weeks. March recorded the highest sales throughout the Ellipse development. We also had record high interest rates during that month, and really, I think, testimony to the type of product that we brought to the market in our JV partnership with Breakout. In terms of GLA under development, we've got roughly 23,000 under construction. That includes 3 mini units that we're developing on a speculative basis. We're already in discussions with a prospective client looking to take 2 of the 3 units on a lease basis. And we're also looking to complete the 3,500 square meter expansion for Amrod just after year end. We have roughly 36,000 of pipeline developments, including the Phase 3 of Ellipse, as well as Phase 2 of the Vantage data center. Phase 1 was completed last year, a world-class data center facility, and we're quite proud of that development, looking forward to Phase 2. In terms of Waterfall Junction, this is our next logistics development in Waterfall, and I've got a map that I'll put up on the screen shortly just to orientate you, but this is a joint venture with Sanlam Properties. We currently hold just over 24%, and we've exercised an option to increase to 50%, and we're currently implementing that acquisition. Last year with our financial results, we provided the market with some guidance indicating that we're targeting growth in our distributable earnings per share of between 8 and 10%. I can confirm that we're well on track to meet that range of guidance. The proposed GPF Waterfall City transaction is in progress. We're making really good headway in terms of finalizing those legal agreements. And once that is finalized and signed, that'll trigger a SENS announcement detailing the full terms of that transaction. Quite a transformative transaction for us. It's a 2.8 billion rand transaction whereby the GEPF will be acquiring 30% of all of our assets here in Waterfall City, including the completed assets, the developments that we currently have under construction, as well as the development bulk that we'll roll out in the future. I think as much as it's a transformative transaction for Attacq, a really great investment from the GEPF, who are always looking for quality real estate investments. And this gives them an opportunity to acquire an existing completed income producing portfolio, but also gives them the ability to share in future developments, given that they're also acquiring a pro rata share in the development bulk. As part of the GEPF transaction, we've been working with our funders. The full proceeds of the transaction will be utilized to pay down debt. And so, as you can imagine, we've been in a lot of discussions with the lenders. They're obviously disappointed being paid down, but we're using this as an opportunity to refinance all of our existing debt at lower and more favorable rates, but also look to potentially enter the debt capital markets as a phase two as part of this refinancing process. From an Ikeja perspective, the disposal is still ongoing. We have not made significant progress since we've last reported at the December level. Our counterpart is busy with two aspects, the fundraising aspect with regards to the purchase price, but also the Competition Commission filing process. Fortunately, in Ikeja, in recent weeks, we've seen the dollar illiquidity position improve significantly. However, we've seen that the official Naira dollar exchange rate has moved out closer to the parallel market rate. So it's a little bit of a double-edged sword, but certainly we're seeing the ability to repatriate funds out of Nigeria improving significantly.
Just a quick touch on some specifically sustainability matters in the operational world. We've installed, we said at our half-year results, we're installing automated generator controllers. We've done that in most of our assets where we've got generators. So far, the data shows that we're saving between 30 and 40% of the diesel through the installation of these generator controllers, which allows us to switch them on and off in non-core hours. Water consumption, we've added loggers at the bulk level at all of our properties, certainly uncovered a lot of leaks, wasted water, and maybe once again important to touch on that these savings when we stop water leaks is not just our savings, but we're also saving a lot of money for our tenants, because in some instances they would have contributed or paid for that water that was lost. In our water resilience projects, we've recently approved 21 million rand worth of backup water storage facility capex. The intention of that water resilience project is to bring the resilience of our properties up to 5 days where it is practically possible. Just to note that it won't be practically possible to do that at all the properties, but certainly that is our intention to do it where we can. We are also investigating battery backups at all of our assets, certainly investigating multiple business cases. There's different ways to skin the cat when it comes to batteries, but certainly it does look at the moment that you would need some form of tenant participation to make that work from a feasibility perspective.
And just to introduce the executive management team, in the picture there is Jackie, our CEO. She sends her apologies. She's taken some time off just to spend with her family. To the left of her is Vina, our company secretary, and then Janine, our social executive who looks after transformation and human capital. Behind her is David, our head of developments, and then behind me is Peter de Villiers, who is our Chief Investment Officer, and then Mike again. Just to provide you a high-level overview of Attacq and our portfolios, the total assets within the portfolio are just under 22 billion, and these numbers are at December 2022. If you look at what makes up the total asset base, Waterfall City comprising of 13.4 billion, or around 62% of our assets. So this has grown to become a significant or the most significant part of our balance sheet. It also contributes just over 58% of our group's distributable income per share. Then you've got the rest of South Africa portfolio, 6.7 billion, or just under 31% of total assets, and contributing 29.5% of distributable income. And we quite often get the question around, should we become a Waterfall's only listed property fund? And we certainly like the diversification that the rest of the South African portfolio provides. These are quality assets, and again, precinct focus. So you can see Linwood Bridge, the precinct in Pretoria, making a significant part of that rest of South Africa portfolio. We've got Mooirefield Mall in Potch, Eckstad Mall in Stellenbosch, and Gardenwood Mall in George. And really the diversification we saw through COVID really assisted companies like us, where retail, in some part took a lot of strain, but there was the first out of the blocks in terms of recovery, and office or collaboration hubs also had a different, response to the pandemic. And so certainly the diversified approach is something key to our strategy. And if we look at other investments, this is roughly 1.6 billion of asset value, making up 7.2% of our total assets. This includes our investment into Africa, comprising of Nigeria as well as Ghana, but it also includes our 6.5% stake in MAS, which is another listed property company which is focused in Central and Eastern Europe.
I'm going to touch on some of our asset management focus and philosophies. I'm not going to go through our precinct strategy. Most of you know, and Raja said it earlier, we try and keep our business really simple, managing and focusing on these 6 precincts that we own in South Africa. When it comes to a management philosophy, the 4 blocks on the right is quite important to us. My team know that if they come with a suggested improvement or project and it doesn't cater to one of these 4 blocks, it's really going to be tough work for them to try and get it approved. So we try and focus our people's attention on where we generate the most impact. Maybe by illustration, I'm going to just give you 2 examples of that. If we look at community focus, in December of this year, we opened up a ramp in Eckstad Mall in Stellenbosch. For those of you that are familiar with that asset, the Checkers trades on the bottom level and the Woolies at the top level, but the street is sort of in between the 2, so you have to access either one of those levels through stairs. After the addition of the ramp, not only did we get a lot of plaudits and appreciation from some of the disability organizations in Stellenbosch because we made them all more accessible, but also the trolley shoppers were able to move their trolleys up to the street level. And since then, Checkers' turnover has increased by 27% for the 5 months since December. On the client experience, we've been using a data tool developed by a financial institution in South Africa to make leasing decisions in Mall of Africa for the last 12 months. So what we do is we take the spending behavior of Mall of Africa clients outside of Mall of Africa, and we base our leasing decisions on that. And that's borne a lot of fruit for us. Certainly, those tenants have been sustainable from day one in Mall of Africa, but also we now place tenants in the mall that shoppers already shop at, and certainly adding to that client experience.
So we're running out of time, so I'm going to maybe just spend a little bit of time on this Waterfall City slide, just for everyone's orientation. So if you look at this map, on the top of the map, that's the M1 North traveling towards Pretoria. At the bottom, it's the M1 South traveling towards Sandton. So really, this has been an infill development. All the shaded in areas are pieces of Waterfall that we've either developed and sold or developed and held. And most of this is what we currently have in the portfolio. Towards the left is the core of the Waterfall City, anchored by Mall of Africa, surrounded by a number of collaboration hub developments, as well as our hotel and ellipse development. And towards the right-hand side or the eastern side of the highway, we've got our logistics precincts, most of which has been developed, except for the dark blue towards the right, which is what I refer to as Waterfall Junction. This is 600,000 square meters of bulk. We're busy completing a water pipeline connection, increasing our stake to 50%, and we really see that this is going to be a key development area for us. This is big box development for retailers and third-party logistics providers. It is in the absolute center of Gauteng, so really a perfect place to set up a logistics precinct, and we're very excited about rolling this out in the future. Some of the stats towards the right, I'm not going to go through all of it, but really Waterfall City has come a long way in the last sort of 10 to 15 years. We've got 8 schools, a hospital, a heliport, over 6,000 residential dwellings, and a lot more in the pipeline. I think we're going to wrap up. Just quickly on interest-bearing borrowings, I alluded to this already, and I think really what I want to show here is that we've got 8.1.5 billion rands worth of debt. That'll reduce by 2.8 billion with the GPF transaction. It'll have an impact on our gearing, which is currently printing 38.1%. We expect that to reduce to 25%. We're expecting on the back of better credit metrics that our margin will reduce between 25 and 35 basis points. And as a result of the reduction in debt, our hedging percentage will increase from 56% to north of 70%. Our profile of our debt maturity will also change significantly as we are refinancing all of our debt. In the interest of time, I'm not going to go through the rest of the slides, and I'm going to make sure that we've got enough time to take some questions. Over to you, Deborah.
Thanks, Raj and Mike. Yes, ate into a bit of our time, but very interesting to hear all the latest developments and what's happening at Waterfall City. Just now, if you guys want to join the breakout rooms, it's your turn to click on the button at the bottom of your screen. It will be hosted by Mark Tobin and the Finance Ghost. And without further ado, I'm handing you over to those hosts. Thanks very much.
Hi Raj, hi Michael, and welcome to everybody who's in the Attacq breakout room. If you do have any questions, you can just pop them in the chat to me, and we'll tackle them over the next 20 minutes or so. But just to kick things off, I don't know, maybe this is more one for Michael rather than Raj. Just on the solar investments that you guys are making, given the changed regulatory environment, where the possibility of selling solar back to municipalities or provincial, or not even provincial, but other big users, is that something you're thinking about as a potential future revenue stream? Just given the amount of roof space that you guys have, there's obviously First Prize is supplying everything that you need to cover your own needs, but then now we have this environment where wheeling is coming in, and you guys obviously have a lot of roof space that probably will be generating excess. Is something you're thinking about? Maybe let's push it 12 to 36 months down the line.
Yeah, so the truth, Mark, is that if you look at the 3 tiers of assets that we do own, retail assets have got big roof spaces, but they are big users of energy. So at probably our most efficient mall with the most solar added to the roof, it's Mall of Africa, and at peak we generate about 40% of the peak demand when that plant runs, and over a day we generate 12 to 14% of total consumption. So certainly from a retail perspective, it feels like there's not going to be excess to sell back. You're going to have to try and provide as much as you can for your own property. Offices face a different problem, small narrow roofs, so you can't get enough panels on there to really generate enough energy for that office building. So really the option you're speaking about is going to be on our industrial land, and certainly there it would be possible, but we would need a lot of regulation to be implemented. What I mean by that is, let's take the current legislation where there was a restriction on the size of solar plants you could deploy, which was 1 megawatt. When they changed the regulation, we were sort of ready to jump on that and quickly expand some of our plants. But when we interacted with local municipal councils, we realized, well, they weren't ready. So the regulation changed, but we had to get approvals, and they had to go through certain things to allow us to expand our plants beyond 1 megawatt. So, I mean, that regulation really needs to be in place, and also the practical operability of that needs to be in place before we would be able to wheel some energy off the roofs of our industrial sites. I mean, that would really be the only place you'd be able to do that.
Okay. And then just another one, if we just talk about the government employee pension fund deal, is there scope to do more JVs with with them on some other assets, or potentially going after a precinct together, buying something existing there, or indeed some of the other big RA funds? I'm just thinking, the RA funds have such large pools of capital, and you're generally focused on a whole kind of precinct model or chunkier assets where it can help move the needle for them in terms of we're not spending 7 or 8 million on a small little office development or a small little retail outlet. It's your bigger assets that actually becomes of interest to the RA guys and like the government and the PIC.
Yeah. Mark, it's a great question, and I think what we've been seeing from a market perspective in the last sort of 18 to 24 months because the listed capital markets have been under pressure, specifically in the real estate sector. There's been a lot more activity, perhaps we can refer to even as M&A activity with the big pension funds. Obviously, this transaction that we're looking to conclude is one of the larger ones, but certainly I think the private pension funds are looking to acquire quality assets, and they've certainly been chatting to, I think, the listed and unlisted property space. And I think specifically with the GPF, it's not something that we've specifically explored in terms of doing more together, but they certainly have got an appetite for quality assets, and they're looking to partner with good management teams on these good assets. So I certainly think there's potential in the future. We obviously would like to bid this transaction down, and given that it's an acquisition in the company that holds all of the assets in Waterfall, through that, as we develop all more out in Waterfall, they'll be owning a 30% stake. So there's this natural mechanism to increase their stake over time as we build out more. If we think about other precincts, again, we're very, very focused. We're very picky about the assets that we hold, and I think in terms of further acquisitions, etc., there's certainly something that we can consider. But we've got so much opportunity here in Waterfall to develop across the asset classes. I think our focus will stay here for the foreseeable future. In our other existing precincts, we see opportunities for further consolidation within those areas, perhaps some expansion opportunities, and those are things that we will continue to explore. And if we think we need a financial JV partner, I think the natural choice would be to chat to the GPF or other pension funds.
Yeah, and we got a couple of questions from the audience. One is, yeah, I mean, this is, I guess, having worked on a few deals, a bit like how long is a piece of string, but when will that kind of SENS announcement, do you think, going to come out on all the mechanics of the GEFP deal? And then I think the follow-on kind of question is, once that is in place and the refinancing is done, is a share buyback potentially on the cards once everything settles down a bit and the market reacts to the deal, the numbers, the refinancing, and you can kind of get a sense, okay, this is exactly where they're at now, and the share price obviously going to do what it does versus NAV, and then look at, okay, well, is a share buyback, is the dividend policy potentially going to change? Just give us some thoughts on that.
Yeah. So I think from a transaction announcement perspective, or further announcements, what will trigger the announcement is the signing of the legal agreements. And until that point, we can't divulge a lot more. It will trigger the SENS announcement, which will include what we refer to as full terms. So it'll have all the terms and conditions. If there are any CPs applicable to the transaction, it will lay that out. So I think that's a key announcement that everyone should look out for. From a timing perspective, we're hoping within the next couple of weeks that everything will reach that stage. But until then, obviously, we can't provide more information. In terms of the share buyback, it's a question and a topic that we've dealt with and talked about quite extensively over the last sort of 12 months. We obviously believe that our share price is grossly undervalued, and we have indicated to the market that the board is comfortable to do a share buyback. From a timing perspective, what's prevented us from actually actioning one is that we have been in a prolonged closed period with this GPF transaction, and so we haven't been able to execute that. When we come out of the closed period, we can certainly provide that mandate to a broker to start on the share buyback, and completely agree with the market. This is something that we have, like I said, chatted for some time, and we firmly believe it's the right allocation of capital given the discount that we're trading to NAV. But we also look at the yield and on a relative basis, and where we can allocate capital, between this and other developments, PV projects, etc. But there's certainly an allocation of capital to do a share buyback as soon as we come out of a closed period.
And then a question kind of around the non-core assets. If we look at the Nigeria asset. Is there more of an impetus to try and get that deal done, given the changed foreign exchange regulatory environment there now? You know, we've seen lots of changes over the years in what happens on the FX side in Nigeria, and you know the window seems to open and close, and the new president has gone on a bit of a market liberalization policy, cutting fuel subsidies, but also letting the currency float. So is that driving a bit more impetus to get that deal done and repatriate the funds and just kind of close off that part of the strategy and really focus on the South African business?
Absolutely. So I think you're 100% right. I think the regime change has opened up the FX markets somewhat. This transaction is quite a large transaction. We would need to, or the buyer would need to secure a significant amount of dollars. So whilst we've seen a bit more liquidity, and we've actually been able to repatriate some of the Naira that we've built up over the last couple of years through the structure in dollars, that's been quite useful. But we still remain committed to selling the asset. I think the FX, the changes in the FX market can assist. However, the exchange rate has moved out significantly. The official exchange rate used to be 450 to 500 Naira per dollar. It's now moved closer to the parallel market rate of close to 700. So it does make the transaction from a dollar perspective a little bit more expensive if you need to convert more Naira into dollars. But as I mentioned, we remain committed to exiting this particular asset, and we've got a couple of hurdles with our buyer to overcome before we get there.
And maybe the next one from Michael, just on the trading densities. Especially on the retail side, you've seen good trading densities. I saw Growth pointed a trading update this morning, talking about how good the trading was at, let's say, the V&A Waterfront, which is one of their largest assets. It seems a bit out of sync with the results that the actual retailers themselves are putting out there. The REITs are saying, we're seeing good trading densities, good footfall, definite. The spring back from COVID is still in essence in terms of people rocking up to malls. But then when you look at what the retailers are putting out, it seems to tell a different story. So maybe give us your view on, how you can be seeing densities up, but retailers saying they're feeling a lot of pain.
Yeah, I would definitely agree with that. So, I usually, when I get this question, say to whoever's asking it, I'm probably not the best reference point for where retail is going in South Africa because of our quality asset base. And I don't think that it's representative of all retail in South Africa. We received a report yesterday from Belinda Kleur, who does analysis in South Africa in the retail, and our portfolio outperformed her entire population when it comes to the last 12 months from a density growth perspective. So certainly, I think we were the net winners, and somewhere there must be some losers to make up for that. I think the quality of your assets is important. If I think about the retailers currently, they were quite bullish about 6 months ago. We were doing a lot of deals, a lot of upgrades. Certainly in the current environment, I think they've pulled back a lot. So potentially slightly more difficult for us to secure new brands, upgrades of stores, etc., going forward in the next 12 months, while they sort of consolidate in this difficult trading environment. But I would almost say it's a validation for our precinct and our geographic dominance strategy. We like to invest in retail assets that are dominant. Even if you look at something like a Linwood Bridge, it's very much curated towards theatre, restaurants, and some lifestyle. With the Safari and Outdoor and the Pro Shop and the Trek Bike Shop. So we try and dominate those categories in a congested place like Pretoria, and I think that strategy has worked for us.
And then if we think, slightly longer term and the strategy around precincts, is there potential in South Africa for another big greenfield project like Waterfall City? Or, are you going to be restricted to kind of more infill or a potential redevelopment opportunity to grow the portfolio? If we start thinking, 5 years from now, when a lot more of Waterfall has now been built out, and what's the next Waterfall? I guess is what I'm trying to get at.
Yeah, Mark, maybe I'll take that question. I think maybe as a starting point, the bulk that we have available here in Waterfall will keep us busy for the next 10 to sort of 15, maybe even 20 years. If we think about, the mixed basket of rights that we've got, light industrial, a lot more office, and to some extent residential, etc. So I think we've certainly got enough to keep us busy and focused here in Waterfall. I think if we look a little bit more broadly, and maybe not specifically around Attacq and its strategy, I think Waterfall City, this particular development, it took a great number of years to come together before even a spade was put into the ground. A lot of planning around town planning, infrastructure, working with local council to secure the bulk infrastructure around electricity, water, roads, etc. And that was done 15 plus years ago. And it's unfortunate to say, but I think to replicate something like that in South Africa, one, where would you do it? I think Waterfall was strategically placed as an infill development between Pretoria and Sandton, and as those two grew, it created the opportunity for Waterfall, and very well located just off the highway, and centrally located in Gauteng. But I think, if you look at the state of local authority and local government at the moment, trying to secure the bulk infrastructure for a project of this size, again, the electricity provisioning, the water provisioning, we're already seeing local council pushing back on, further water pipelines because of potential capacity issues, and likewise Eskom grappling with capacity across the board. So I think to replicate this would be extremely difficult, even if someone had really, the financial means and even the right tract of land. We're certainly seeing that to get all the stars aligned to roll out something like this at this type of scale is becoming very much impossible in South Africa.
Oh, well, Eskom is next door to you. Maybe they'll be looking to shop a megawatt park at some point. You can just tag it on as a Waterfall megawatt park or something like that. Maybe that could be an expansion there. I just wanted to make, and Micah, I know you kind of touched on it in your comments in the thing, just since Growth Point was also out this morning, and they give a couple of updates on rental revisions, and it's obviously still in the negative, but they're not as much as they were, and that's on office, retail, kind of all of the various aspects of their portfolio. But maybe in the Attacq portfolio, would you go along with what Growth Point are seeing, that it's definitely, while it might be negative, the trend is definitely going in the right direction?
Yeah, so it depends on how you look at reversion. So certainly from our perspective, when our full year results will come out in September, it's going to be important for us to explain the numbers. So to give you context, if you just take our retail renewals we've done really well on most of the leases. The fashion guys, the electronic guys. So all of those expiring, we're getting escalations when the leases expire. But within this population, you're going to have a 4,000 square meter Virgin Active that we renewed after 10 years. And you're going to have like a 2,500 square meter Dis-Chem that we've renewed. So maybe in the numbers we disclose, it's going to be negative or maybe close to static, but you have to exclude those two leases to get a different number to give you a better picture of what's happening with 95% of the other retail leases. So we're going to have to do a good job to really disclose what's happening there. So I feel stronger about some of the retail ones, with one or two exceptions. And I think office, what's interesting on the collaboration hubs and offices is we're not seeing market rental reverting. What I mean by that is, where we've had a guy with in-force escalation for 5 years and he's coming up in one of our office parks in Waterfall, there's a reversion. But is that level that we're renewing at going backwards from where we were in 2021 and 2022? The answer is no. That's increasing. So it's almost like the level at which we are doing new deals is increasing slightly vis-a-vis, let's say, 2021. But if the guy's been in a 5-year lease, there's a reversion on the exit. So once again, I think from a disclosure perspective, maybe you can do some work there in bringing some clarity on what's happening with the deals we're signing on a day-to-day basis.
Okay, yeah, that makes sense. I think it's good to give that context, as you say. It might be a reversion on what he was paying right as the lease ended, but that's still, you know, ahead of where he actually kind of started back 5 years ago. So
maybe we're getting 10 rand a square more than we did in 2022, but it has to be contextualized.
Yeah, no, exactly. Guys, I've got the 2-minute warning from Deborah here. Rather than me throwing in another question, do you want to just give us maybe a quick closing remark, Raj or Michael?
Yeah, I mean, thanks for everyone for joining us. Hopefully, we've provided you with a little bit more insight into Attacq. You know, we're going to a close period at the end of June, and like Mike said, our results will be coming out in September. Look forward to bringing you those set of results. And as confirmed a little bit earlier, we're on track to meet our 8 to 10% projected growth in distributable earnings per share. I think overall we're well set for the June 2023 results.
Yeah, and hopefully the government employees pension fund deal will be, you know, wrapped up in time, that all of that can get factored into the results, and, you know, to make for a very interesting results presentation. Okay, I think we'll leave it there, and we're just going to move back now to the main room and just get a couple of closing remarks from Deborah, and I'd like to thank everyone for joining the Attacq breakout room today. Thanks, Raj. Thanks, Michael.
Thanks, Mark. Cheers.
Okay, I think let's jump into it, guys. So I'm obviously handling this room. It was a bit of a nightmare morning for me with a Saturday flight that never happened. So I was supposed to be taking this from Joburg. I'm still in Keyter. But such is how life goes sometimes. So to the Tharisa team, Ilya, Michelle, thanks for making time today. And especially given that you know, your chief executive is running around Zims at the moment. So we're grateful that you guys are on the call with us, and such is the joy of, I suppose, mining. You got to be on the ground when these things are happening. So I think to those in this room, send your questions through to me. It's obviously it's a dual company event this time around. So Mark Tobin's taking the other room, I'm taking this one. So just make sure you send it directly to me, please. And I actually want to start off with a little bit more of a general mining question, because I think there's always an opportunity to learn about this space, and that is, you know, people talk about shallow resources and then deeper resources as well. And is the cost differential on these things truly that one is viable and one simply isn't? You know, is the cost to mine so different that it can make that much of a difference to whether or not you actually move forward with a project, whether it's shallow or deep?
So Mark, that's a really good question, and it's something that we debate, because clearly we have a long life open pit mine, and then we have an underground mine. To start off with, absolutely, open pit makes a whole lot of sense. It's not power intensive, because clearly you're above ground, so you're not worrying about cooling and refrigeration and the electricity constraints that we deal with on the one hand. Typically, when we certainly started 10 years ago, the number of people that we would have in an open pit mine versus an underground mine were substantially different. So where we would have had 2,000 employees, you'd have had 12 to 13,000 employees underground. And it's a very different nature in terms of the skills base, underground versus open pit. I think as time's gone on, technology has changed things, automation has changed so much. So whilst there's still a differentiation in terms of underground mining, I think technology's opened the door towards underground mining being more viable, provided you're using innovative new technology. So certainly not something that we're not going to do at any point in time. I think if you'd asked us 10 years ago, we'd have said no. I think the world has changed a little. We've certainly benefited from being an open pit mine, because you can be at the lowest cost quartile and you can manage those costs more effectively. Underground, definitely doable, can do, got to manage those costs, and it's all about automation. So I hope that helps you a little bit.
Yeah, that does. Michelle, yeah, my ghostiness is working too well here. Because Mark's call me ghost, I'll let you off. I've got a question in my DMs here. How do you manage the constraints of Eskom and Transnet? Obviously, the two that always come up. And what is your outlook on those constraints potentially worsening? How can you mitigate the impact?
Okay, so clearly my hair is colored. I'm not gray yet. Look, guys, infrastructure in South Africa has been an ongoing issue for every single one of us. Doesn't matter what business that you run. So firstly, from a power point of view, I think, again, the nature of an open pit mine has benefited us because you don't need power other than for your nighttime operations in terms of lighting, because you're running trackless motor vehicles and you've got big trucks and excavators. In terms of our processing plants, what we've got there is we've got some flexibility because we run two independent plants. The one is the Voyager plant, which is a 300,000 ton per month processing plant, and the other is 100,000 tons. So typically what happens is when we have load shedding in South Africa, the mines will get load curtailment. So Eskom would come to us to negotiate returning some power to them and lowering our power usage. So to that extent, what we can do is we can slow down some of our mills. We can apply the gen sets that we've got, takes us up to about 12% of our capacity on the smaller plant. So we've got flexibility to maneuver within the power constraints. So far, we've been able to manage well. It doesn't mean to say it's an optimal situation because clearly our suppliers are constrained by power and so on. But I think largely we've been successful so far. Going forward, the development of our solar plants and what we do there becomes really key in terms of us becoming more sustainable. Now, clearly the whole of South Africa is focused on renewable energy. So I think as time goes on, we'll have our own initiatives and we'll see more and more coming through. So I'm always an optimistic South African. So I hope to see some very big developments coming through. From a rail point of view, I think that's the one that perhaps confounds us a little bit more because it's certainly something that we live with. I don't think the ordinary man in the street understands the constraints that we deal with from a logistics point of view. We've had a breakdown in terms of Transnet, and that's rail capacity. So that's moving our product by rail to port. Now, typically, we're moving 1.6 million tons of chrome concentrate to port. That's a lot of either trains or trucks. Our rail capacity has diminished, so we've been able to substitute it with road. What we've done to ensure that we're flexible as well and a little bit agile is we move through Maputo, we move through Richards Bay, and we move through 2 different ports in Durban. That's given us some flexibility by being not only limited to South Africa. Guys, the reality is there is a premium that you pay for road transport, but it's about getting your product to port. And I think we can talk for a long time about the inefficiencies of road and what it does to each one of us as a person living in South Africa. I think from a business point of view, we've been able to navigate it and navigate it well. We've got port in multiple stock in multiple ports, and with that we can move it out to China. The situation is not sustainable into the future, so we really need to find solutions with government in terms of what is done on infrastructure, because it's not just outgoing commodities, it's commodities coming into the country. But again, we can talk for a long time about that. I suppose suffice to say, for where we are right now, I'm pleased with the way our team's handling it. We're moving all of our stock. We haven't had we've had constraints, but we've been able to navigate it and move successfully to our clients.
Thank you. It's so interesting to see the questions coming through in the DMs and how themed they are. So many people on much the same page. So there's a couple that have come through about your Caro project, and the question is, to what extent you can talk about what this will add to revenue. People are very interested to understand what that looks like in future. How big is this project? What can it add? And then what are the sort of CapEx requirements to get there? So, to the extent you can answer some of this or give some guidance, obviously up to you what you can give. But people just looking for numbers.
Yeah, sure. We've been working in Zimbabwe for a long time, and we've had a lot of exploratory discussions over the years. So excuse the pun, but we've been looking at it continuously over a long period of time. And so when we went into Zimbabwe, it wasn't an uninformed decision. It's something that we're familiar with. On the one hand, we've done it in South Africa. And I'm one of the ones that've been here from the day that there were sunflower seed fields in the vicinity of the Tharisa mine. So I've seen it develop from being green fields to having 2 highly producing plants there. In Zimbabwe, it's capital intensive to start with on phase 1 in terms of our concentrator that we built. So I think that's some $390 million. What we'll do in Zimbabwe, which is a little bit different, is we'll go with a mining contractor model to start with. We did that in Tharisa in South Africa, and then we went into owner mining. So we'll contain some of our capital costs by doing contract mining to start with, and we'll develop our concentrator plant and own that and develop that. Over time, we'll reevaluate and check it and see whether we we go into the owner mining model. For now, that's not what we're going to do. In terms of going forward and why Zimbabwe, I think Zimbabwe is a mix of a story of what people have seen over the years. I think it's the hope for many Africans in terms of what we see in terms of growth potential out of Africa. I was at a talk a little while ago, and it was very interesting when the discussion was around GDP growth. And what alarmed me as a South African was to see that, GDP growth in South Africa is expected to be at 0.05% or whatever the number is. Yet in the African countries surrounding us, we see growth expected of single-digit numbers. So one will say, well, Zimbabwe is coming off a low base. Well, it may be, but it's been sustaining itself for some time, and we've seen growth. When we as Tharisa look at it, we look at the fact that who are our neighbors? Impala, as through Zimplats, is there. Anglo is there through Unki. Mimosa is there, which is Sibanya and Impala in terms of a JV. We've got good neighbors, guys. They'll all tell you that the work in Zimbabwe that they've done has been sustainable, that they've made good profits, they've had good returns, and they've been able to develop their mines successfully. In South Africa, you don't have the scale of a Karo project available to anyone to consolidate and bring into your mining footprint right now. So growth in the PGM space, in our view, comes out of Zimbabwe. That's the next biggest PGM, the biggest deposit from a mining resource point of view. The benefits in Zimbabwe is because it's relatively low in terms of mining scale and hasn't developed as much as South Africa, means that a lot of it is open pit or shallow mining, and you don't have the intensity of deep mining as you have in South Africa. That will come in years to come, but for now, your development is a lot cheaper than it would be in South Africa with deep level mines. So I'm going on and on a little bit, but there's a lot to consider when you consider investment in Zimbabwe. And number one, that there are those that are successful at it. We certainly believe that we'll be successful, and we believe it because we've gone from being a development asset to an operational asset at large scale volume. Hope that helps, Mark. There's lots more we can talk about on that.
I guess you've given the level of detail that you can on this. A lot of the, it's interesting to see how Zims is sort of looking a bit more lucrative than South Africa at the moment. I thought the cement results recently depressed me, but that can just add to it now. Some of the questions are around PGM basket prices. Obviously, people always want to know the view on what sort of PGM prices do you see going forward, but also the question here, when you're making capital allocation decisions, what sort of assumptions are you using, not just around PGM prices, but for example, electric vehicle uptake versus internal combustion engines. So just any commentary around that outlook for PGMs in general.
Yeah, look, I'm going to answer a little bit. I'm going to ask Ilya to come in too, so that you're not only hearing my voice. But look, a little while ago, we were at Platinum Week in London. I think during that time, the resounding message coming through was that the contents of the PGM basket being platinum, palladium, rhodium, gold, iridium, and ruthenium. And I'm kind of focusing on that to say to you, PGMs is not platinum only. There are many commodities or metals within that. Each one of them has unique capabilities and encourage a different type of industry. So what we see coming is that you've got platinum and palladium, which we're familiar with in terms of autocatalytic converters and the industrial combustion engine and the motor cars that we drive. And we certainly know that those autocatalytic converters talk to reducing emissions and carbon emissions. What we see emerging at the same time is a hydrogen economy, and everybody's focused on a cleaner environment. So battery metals, we can argue about battery metals and say to what extent is it clean, but the point is that there's an awful lot of innovation coming that into the future, and all those innovations require the elements of the PGMs that we produce. And that's why we believe in the long term, short, medium, and long term, PGMs are sustainable. The product is more and more into deficit. And the reasons why it's in deficit is because there's been lack of capital spend on the development of mines. You've got to differentiate between developing a mine and adding to your processing capability. You've got to spend money to develop your mines going open pit or shallow or underground. And separately, you're going to put capex to your processing capability. So where mines haven't spent enough money on developing their underground mines because they've kind of been mining it for the near future, short term, there's a problem there. So I'm going to stop there for a second and ask Ilya what he'd like to add around PGM, but certainly we see the outlook being positive in terms of PGMs and PGM pricing, even though it's in a lull right now.
Yeah, I think the innovation side that Michelle addressed is significant, and what you've seen is now fuel cells aren't anything new. Fuel cells, Anglo Platinum spoke about them when I attended their results presentations in the late 1990s. But what's happened is that the other side of the industry is becoming much stronger. So what you're seeing is you're seeing a lot of capital being spent in terms of developing these fuel cells. So the technology was there, but the commercialization, I think, is something that people were missing. And the forecasts are for roughly 1 million ounces of platinum, and it is platinum that will be used in these fuel cells to be used for these fuel cells. Now, nobody is arguing that electric vehicles are not part of the future. However, what we are seeing is, and where our view is, that there's enough space for the internal combustion engine, with much cleaner catalysts out there. So you're seeing China increasing their emission standards, Europe increasing their emission standards. You're seeing hybrid vehicles and electric vehicles all going to be part of the drive mix into the future. I would love to say, as a believer in electric vehicles, despite working in PGMs, that electric vehicles are going to be the end all, but I just can't see the infrastructure out there that's going to power these electric vehicles. I drive a very cute Mini. You can get electric Mini from Mini today. If you want to drive to Durban, you're not going to make it to Harrismith, which is the original, or the first, should I say, charging station, and then you're going to have to queue because there's only 2 charging stations to get there. So we're looking at that mix. Now, the supply side, I think, is often misunderstood. And as much as PGM prices have retreated by $200, $300, $400 over the last 2-3 months, if they sustained at these levels, I can tell you right now, there's a lot of opportunities in South Africa that are already underwater and will remain underwater. And the companies are simply not willing to mine unprofitable ounces. So the supply side is going to suffer. And I think that's not just true for PGMs. The supply side for commodities is a strenuous environment. Why? Because investors want quick returns. I think they tend to forget how long it takes to build a mine. And this is where Kara fits in. It's actually an 18 months build. If you're looking at some of the other PGM projects that are being looked at in South Africa, 5 years minimum build before you start getting into cash flow. So the supply side is really something that needs to be looked at. And most analysts are waking up to the fact that it's going to take much longer for any new supply, if at all, to come to the market.
Ilya, you'll be pleased to know I'm a die-hard petrol head and I like things with all the cylinders. So I'll do my best for your PGMs. A little shout out to Mali Changa on Twitter, one of my favorite accounts to follow. Young investor at Jason_invest, writing very cool stuff on Twitter at the moment and certainly paying attention in this session. Kudos to him. Last one that we probably have time for, geopolitics. The rift between East and West seems to be getting worse, not better. I note that China is a big market for you. Obviously, if we get Western sanctions, I doubt strongly that China will care much about buying chrome from us. They'll be on our side of things. Your exposure to bluntly East versus West, are the commodities going East because that makes you probably quite safe from a sanctions perspective? Or is there significant sale into Europe, into America? Maybe a tough one to answer, but I think a tail risk at the moment that is on people's minds.
Yeah, listen, it's an interesting conundrum we find ourselves in, because I think there's no doubt that there is development and innovation happening in Europe, but it's a little bit late in the day, and it's going to take some time for some of those, stainless steel, for argument's sake, or steel factories to emerge and do the scale that you would have out of China. We can't underestimate what China does for the rest of the world in terms of stainless steel, white goods, motor vehicles. They're playing a significant role in every single industry which draws from our commodities. So in the first instance, East meets West and the issues that we've had out of Russia and Ukraine, there's no doubt that it's affected every single one of us. It's affected our businesses, whether it was through fuel prices running, whether it was through logistics constraints at the time, because we certainly saw problems with vessels going in and around Russia. And then fundamentally, what was going to be the outlook in terms of PGMs, Were the Russians going to offload their palladium? What did their inventories look like? I think at the end of the day, business sense will prevail as well. I think there'll be a channel to market for some of those projects. And I think, again, sanctions will be on individuals as opposed to the country as a whole. So it's not easy to navigate, not something that people are going to do willingly, but that provides opportunity for Africa. And where it gives us opportunity in terms of Zimbabwe and our growth in terms of PGMs, PGMs are going to go to multi-commodity markets. It's going to go to China. It's going to go to Europe. The supply-demand fundamentals are strongly in play. In terms of chrome concentrate, well, you've got the majority of your stainless steel production happening in South Africa. In China. It's not replaceable. We move with success into China. I don't see that can stop quickly or just be because somebody presses a button and says, listen, there's going to be sanctions applied between the rest of the world and China. I just don't see it because I just don't think it's practical. There's too much of a dependency on China for too many commodities. So I think some common sense will prevail. And at the end of the day, we see stimulus packages coming out of China. We see decrease in terms of interest rates. I think generally we see an increase in terms of market sentiment. If I look at chrome specifically, and I know our time's running out, we're sitting at $295 a ton. I'll take you back 2 years and say to you it was at $120 a ton. It's a significant increase to 295. So my problems are first world problems when I'm dealing with chrome price because we're making good margins, there's good profitability. Supply is constrained in South Africa simply because I think that there's been a consolidation across the chrome market on the one hand, and secondly, you've got to be able to fund your pipeline. And funding your pipeline, we've spoken about the logistics challenges. So you've got to fund your logistics challenge, your logistics solution to port, getting your product to port and shipping it out. We've come from producing 100,000 tons per annum to producing 1.6 million tons per annum. It's something that I'm proud of, and we found out.
Thank you to everyone who participated in Unlock the Stock today and the teams from Attacq and from Tharisa in particular. And a special thank you to everybody who dialed in to the session and for making time to support this investor platform. We hope you've enjoyed this event, and if you'd like to listen to it again, it will be on the Unlock the Stock YouTube channel soon. We do encourage you to subscribe to the channel for all our latest videos. Please join us for the next session of Unlock the Stock on Thursday, the 13th of July, to hear from the PBT group. So please look out for that invitation. Thank you and bye-bye.